As we heard earlier, markets around the world have been shaken by a perfect storm of the coronavirus and an oil shock, and the NZX Top 50 was down around 5% in early trading this morning. Westpac market strategist Imre Speizer joins me now to make sense of how the markets here and abroad are responding. Good evening. How did we fare today off the back of, what's been described as a black day on the markets overseas?
Overall, a bit more calm relative to last night. And I'd say last night in the US was probably the height of the panic that we've seen in this pandemic, where we had, the US stock market plunging 7.5% and having to be halted at one point because it fell too fast early on. But today, it seems that maybe the market's fatigued by just selling every day. There's no obvious cause behind it, but we've seen markets somewhat stabilise, certainly currency, certainly interest rates. Most of the equity markets in the region, the Australian and most of the Asian bourses, they're small ups for the day. The New Zealand Stock Exchange closed down about 1.6%. Of course, that's a much smaller exchange, and it tends to be dominated by a few individual stocks, so I wouldn't read too much into that. But yeah, overall, a sense of that things are a bit calmer than they were last night.
Imre, you talk about panic last night. What specifically brought that panic on? Because obviously, coronavirus has been around for some time now. Was it the oil shock? Was it the timing of that, the perfect storm?
Not so much. No, the oils are probably a separate case. Sure, the pandemic is impacting oil prices, but there's a separate thing going on there independently, which is the OPEC producers who have had a bit of a fallout and they're not agreeing to cut production. So it seems like there might be a bit of a price war going on in the oil market. Put that to the side, though. Markets in all asset classes, whether they're asset, currency or bond markets, they're all pretty much watching one thing, and that's the number of new cases each day. First, they started watching new cases in China. That rose, then it made a peak and it fell, and the markets thought, okay, that's all over now. Then we saw cases outside China start to rise, and we're still in the upward part of that profile. We haven't reached a peak, obviously. In fact, cases outside of China are still accelerating, and this is what's unnerved China. In addition, the US is going to start testing on a much wider scale than it has, and there is the expectation that we're going to see lots of cases coming out of the US, which is a bit of a worry, and it could have an impact on the US economy as well. So those things really unnerved US markets in particular, but everything else followed suit.
So Donald Trump, on that note, is talking about a business support package and numbers around in the billions. Is that enough to calm the situation?
Well, generally, yes. For this type of thing, a government response is more effective than, say, a central bank response. So central banks can cut rates to as low as they like, and even to negative territory. It'll have much less impact than governments working through the fiscal channels of making sure businesses have money, that employees have enough cash flow to get through. So yeah, these kind of packages are things that are required. So yes, overall, yes, that is along the right track.
So is anyone doing well out of all this volatility?
Interesting. You could probably pick a few sectors that should be doing well, in fact, that are doing well. We know that from the data. For example, in China, we know that online retail businesses, their businesses have soared since coronavirus. So clearly people socially distancing themselves. They don't want to go to the physical shop, but they're quite happy to do it through the keyboard. So yes, online sales you'd expect would do pretty well, and anybody involved in that channel of retail business. Another one would be health products. It's a broad suite of products, but there'll be some that will do particularly well if they're seen to help address or fend off the virus. And very, very small, I know, but I'm sure toilet paper manufacturers, and there's a few of those in New Zealand, will be doing pretty well also.
Imre, how long can we expect it to be like this in terms of the volatility?
We don't know. No one knows, and the medical professionals are the best, or the epidemiologists are the best place to answer that question. Markets are really just following suit. They're just following the data as it evolves. They're looking at, as I say, those new cases every day, but they really have no clue on how long it lasts. However, what we do know is that eventually it will fizzle out, And what we know is that the economic damage caused by it will be reflected in a very sharp rebound the other way. So, for example, we've slashed our first quarter economic forecast for New Zealand. We're expecting a 0.8 rise pre-virus. Now we're expecting a GDP fall of 0.2%. So we basically slashed 1% off our first quarter our growth rate. Q2's also been cut a bit, but we're expecting a very sharp rebound in Q3 and Q4. So we're not sure that's going to be a 3 or a 6 month duration of the virus, but however long it is, we will get that rebound when it does fizzle out.
Appreciate you joining us this evening. That's Westpac market strategist Imre Speizer joining us this evening.